Hi, this is Harish here with Root Vision, Mahesh, and Raghav, and we welcome you to the third episode of the Dogs of the Wall Street podcast, Bonds and Fixed Income Securities.
We call ourselves the Dogs because we look out for your investment efforts and we are loyal to our listeners.
And contrary to the name, which is just a nod to the Wall Street of our home country, India, we will mostly be discussing American markets on the show.
We will be your best friends when it comes to investing during a pandemic, and we're here to help you learn the basics of finance, capital markets, and applied economics. Over the next few episodes, we will be discussing different types of securities ranging from fixed income securities like bonds, stock derivatives like options and futures, and more.
Well, I'd say for a company, if I was running a company, I'd rather issue a bond, and the reason why is because it makes your balance sheet a lot cleaner. You know when you're paying it off, right? If you say that this IOU is timed for 10 years, then yeah, you know that you're paying it off in 10 years. For governments, I think it doesn't make that much of a difference. Like the British government, for example, they issue consols, which is a perpetuity. It's the same thing as an annuity, but it's not on borrowed time. So rather, they just keep paying. They just keep on paying interest, and it never stops. So it's similar as in that it doesn't have a lump sum payment. It just keeps on paying interest. And I guess as a government, it doesn't make a difference. But as a company, I'd like to have that expectation and know that, like, okay, yes, I will be paying it off in 10 years. And I only have to pay interest until then, and I'll make sure that I have the money to pay at the end. Because let's say you're like a startup, then you might not have enough money to take on an annuity type loan. I think you'd be a lot better off going with a bond there.
True. Yeah, I think with government bonds especially, the risk is almost like zero. You're pretty much guaranteed to get your payment, and it looks better. So yeah.
Yeah, like Root just said, it's what's called the risk-free rate, because the U.S. government's pretty much never gonna collapse. You're always gonna be guaranteed that money that you paid.
So basically,
I hope so.
Economic stability and the size of the company depends on if they're gonna pay back that bond or not. And if a corporation is generally bigger, the bond is more secure than, let's say, a startup.
So, what do you guys think about the inversion of the yield curve around August of last year? So, even without the presence of COVID-19 and the whole pandemic that we're going through, would the economy still have gone into a recession due to other factors? And if so, what do you guys think these factors could possibly be?
We can't say that with absolute certainty, but late last year, a lot of big banks were theorizing that there would be another big recession this year. And then once, COVID struck, people were like, oh my God, it's a recession. But then, stocks also bouncing back up, so it's kind of an uncertain time. As for looking back at last year, I don't think we saw a lot of telltale causes or telltale signs that there would be a recession upcoming, other than the fact that, yes, you did mention that there was an inversion of the yield curve, which could be a sign, but other than that, I don't think we saw anything.
Well, it could have been a number of things. It could be tensions in international trade, maybe rising interest rates, so it wasn't really apparent besides for obviously the inversion of the yield curve. So my answer is no. I don't think we would have had a recession if COVID did not come.
Yeah. Okay.
Yeah, I think if anyone could predict recessions, they'd probably be paid a lot and working at a hedge fund. So it's kind of hard to say. But I think that in the situation that we did see some weakness around December, I believe, and then we saw another strong gap up rally because of the tech stocks that were leading, and they're still continuing to do pretty well. But I think that we may have had I guess a bit of a slowdown or a correction, but what we saw during COVID, where the market lost a great big amount of its market cap. I think that probably amplified the effects of what the possible recession or just dip could have been, I guess, right? And but we recovered a strong amount since then, and we may see another drop like we did in 2008 and then again in 2011. So yeah, maybe it's just the recession got delayed, or this was what happened because of COVID, and I guess they all got added up together. All the factors came together to cause that recession. And now we're in a recovery state. That's possible as well, but I don't know. Maybe it's too uncertain of a market for me to say anything.
In times of economic uncertainty, would you personally turn to fixed income securities or commodities to provide a stable investment, and why?
Well, I would say I mean, in terms of like a basic investment, right? Like buying a stock. I mean, obviously in a time of economic uncertainty, I wouldn't do that. But then you could also invest in terms of like shorting a stock or buying put options or something like that. But usually most high profile like investors would flock towards bonds in terms of economic uncertainty, just because, 10 years down the line, if they purchase a 10-year bond option, if they think if it's currently a time of economic uncertainty, they'll be getting that regular interest payment for the next 10 years through that entire economic recession.
Well, so I'd say, depending on how skilled of a trader I am and where my business acumen lies, I might buy commodities. So if you're thinking of like oil, that type of thing, you could probably get like a forward contract that's, I don't know, 2 years from now, when you believe that travel and everything will go back to normal, then probably, oil prices might go up to 100. It's quite a possibility because of the amount of oil, like I said before in I think the first episode, OPEC is limiting the amount of oil that's being drilled. So it might go in the entire other direction where now oil is way more expensive because nobody was making it and all of the operations were shut down. So now there's a limited supply because there was no demand before. But then when the demand does spike up, let's say when the vaccine is deployed, then it could probably take the oil prices to even more than they were before. So yeah, I guess maybe commodities would be a good choice, but it depends on what type of recession and economic uncertainty there is.
Yeah, I think if you're skilled enough of an investor, you'll be able to play the actual recession for your benefit. So it's not necessarily that you would flock towards bonds. It really comes down to, I think, skill and preference and risk tolerance.
I mean, like what type of thing, what type of commodity or what type of investment you want to make is solely dependent on your financial situation. So if I wasn't desperate for money, but like I'm in need of it down the road, it would depend on my personal financial situation. So if I'm not in desperate need of money, but need money, some money down the road, I would make a bond investment. But again, what type of investment you want to make is solely based on your personal decisions and your personal financial situation. So obviously, like I wouldn't invest in a stock during a recession unless I was really desperate for money. But yeah, I would go more towards the low risk investments during a recession because I have a better guarantee that I'm not going to lose my money.
There's some pretty good answers on both sides. Thank you everyone for tuning into the third episode of The Dogs of the Law Street. We hope to see you here again when we discuss our next topic. We will be releasing new episodes every Friday. Follow our Instagram at The Law Street Podcast for updates and exclusive content. If you have any business comments or inquiries, please email them to thelawstreetpodcast@gmail.com. Next week we will be discussing derivatives. Have a great rest of your day.